Right now, while you're watching this, there's a number sitting in your future that nobody's shown you. It's not your salary. It's not your credit score. It's the number that tells you exactly how much money you're going to lose. Not might lose, will lose. Because of three things almost nobody explains to you before you sign up for a 401k. Taxes you can't predict, market drops you can't control, and timing you don't get to choose. Today I'm going to show you those numbers. Real ones. Not hype, not get rich quick. Just math. Most people never see until it's too late to do anything about it. By the end of this video, you'll understand exactly why more families are moving part of their savings into something called an Indexed Universal Life Policy, an IUL, and why the ones who wait 5 or 10 years to learn this usually end up paying for that delay in real dollars. Let's get into it. Here's number 1, and it's the most sobering one. Only about half of American adults currently own any life insurance at all. Half. And of that half, a huge portion admit, in their own words, in national surveys, that they don't have enough coverage. Put those two groups together, and you're looking at over 100 million adults in this country who either have no protection for their family or know they're underinsured and haven't fixed it. Here's the part that should really get your attention. Parents are more likely to say they don't have enough coverage than the general population. Not less. More. The people with the most to lose, the ones with kids depending on them, are the ones most aware they're exposed and still haven't closed the gap. Why does this happen? It's not because people don't care about their families. It's because most people wildly overestimate what life insurance actually costs. Studies show younger adults guess the price of a basic term policy at 10 to 12 times what it actually costs. 10 times. So they never even ask for a quote because they've already talked themselves out of something they never priced. And here's the number that makes this personal. Nearly a third of American households say they'd face serious financial hardship within just 1 month of losing their primary wage earner. 1 month. That's how thin the margin is for most families, mine included, at different points in my life. That's not a scare tactic. That's the actual data. So before we even talk about wealth building, that's number 1, the protection gap. Now let's talk about the second number, because this is the one that surprises people even more. You've probably heard people throw around big numbers for what you need to retire comfortably. $1 million, $1.5 million, even close to $2 million by the time you stop working. Now compare that to what people actually have saved. The typical worker in their 50s, not the ones on the news, the actual median, the person right in the middle, has a retirement account balance that's a small fraction of that goal. Depending on which report you look at, the median, meaning half of people have less than this, sits somewhere between roughly $87,000 and $185,000 heading into their retirement decade. Compare that to needing somewhere close to $2 million to actually retire the way most people picture it, and you can see the canyon between the goal and the reality. Here's why that gap matters more than people realize. Averages lie to you. When you hear the average 401k balance is over $300,000, that number is being pulled way up by a small group of high-balance savers. The median, what the actual person next to you has saved, is dramatically lower, sometimes less than a third of that average. If you've been comparing yourself to the average, you've been comparing yourself to a number almost nobody actually has. So why does this keep happening to hardworking people who are doing what they were told? Contribute to the 401k, let it ride, don't touch it. Because nobody explained the other two numbers that are quietly working against them the whole time. Taxes and timing. Here's something I wish someone had explained to me earlier in my own journey. Your traditional 401k or IRA isn't fully yours. Not the way you think. Every dollar in there has a silent partner, the government, and that partner hasn't told you their percentage yet. You get a tax deduction today, sure, but every dollar you pull out in retirement gets taxed as ordinary income, at whatever the tax rates are then, not now. Think about that for a second. You're deferring the tax bill on decades of growth into your future at a rate you don't get to lock in. And with the national debt where it is and government spending only trending one direction, does anybody really believe tax rates 30 years from now are going to be lower than they are today? Here's the number nobody puts on the retirement brochure. If you have $500,000 in a traditional 401k and you're in a 22% tax bracket when you retire, that's not a $500,000 nest egg. That's closer to $390,000 after taxes, and that's if rates don't go up. If they do, that number gets smaller. Compare that to money that grows and comes out completely tax-free when it's structured correctly. which is exactly how a properly designed IUL policy works when you access the cash value through policy loans. Same dollar amount, growing over the same years, can put dramatically more spendable money in your pocket, simply because Uncle Sam isn't taking a cut on the back end. That's not a loophole. That's the tax code working exactly as it's designed to work, for the people who know how to use it. Here's a number most people have never even heard of. Sequence of returns risk. It sounds complicated, but it's simple once you see it. It's not just what your average return is over 30 years, it's when the bad years happen. If the market drops 30% when you're 30 years old and still contributing every paycheck, you have decades to recover. No big deal. But if that same drop happens the year you retire, right when you start pulling money out to live on, that's a completely different story. You're now selling investments at a loss just to pay your bills, which means there's less money left to ever recover when the market bounces back. Two people can have the exact same average return over their lifetime and retire with wildly different outcomes, purely based on when the down years landed. That's not opinion. That's documented in decades of market history. This is exactly why an IUL is structured the way it is. Your cash value is tied to the performance of a market index, so you get to participate in the upside, but there's a floor, usually 0%. So when the market drops, your account doesn't lose value from that downturn. You don't capture 100% of the gains in the best years. That's true. There's a cap. But you also don't take the hit in the worst years. For a lot of families, especially ones who can't afford to lose ground in their 50s and 60s, trading some of the upside for protection from the downside is the entire point. So let's put all four numbers side by side. Number 1. Over 100 million Americans have a coverage gap, and parents are more likely to be underinsured than anyone else. Number 2. The typical family heading into retirement has saved a small fraction of what they'll actually need. Number 3. Every dollar in a traditional retirement account has an unknown future tax bill attached to it. Number 4. The timing of market downturns can shrink a retirement fund in ways an average return number never shows you. An IUL doesn't solve all four by accident. It was designed to answer all four at once. It puts a death benefit in place to close the protection gap, it grows cash value you can access tax-free to fight the tax number, and it has downside protection built in to deal with the timing risk that traditional accounts don't protect against. I want to be completely transparent with you. An IUL is not a magic solution. It's not guaranteed to outperform every other option in every scenario, and it's not the right fit for every single person or every single dollar. Any specific numbers, caps, and illustrations depend entirely on your age, health, and the policy design. This video is education, not a personalized recommendation, and it's not a guarantee of any specific return. That's exactly why the next step matters so much. Here's what I don't want you to do. Close this video and do nothing with these numbers, the way most people do. Knowing you have a coverage gap and not closing it doesn't make the gap smaller. Knowing your retirement number is behind and not addressing it doesn't buy you more time. The families who end up ahead aren't the ones who knew more. They're the ones who acted on what they knew, even a few years earlier than everyone else. If you want to see what these numbers actually look like with your age, your goals, and your budget, not a generic example, your real numbers, that's exactly what a free strategy consultation is for. I'll walk you through a real illustration, show you the floor, the cap, the tax treatment, all of it, and you decide from there. No pressure, no obligation. Just numbers, laid out honestly, so you can make an informed decision for your family. If this opened your eyes even a little, do two things. First, comment the word bank below, and I'll send you my free family bank blueprint. It breaks down exactly how families are using this strategy to protect and grow generational wealth, step by step. Second, if you're ready to see your real numbers, the link to book your free consultation is right there on the screen and in the description. It takes 15 minutes, and it might be the 15 minutes that changes what your family's next 30 years look like. I'm not here to sell you something you don't need. I'm here to make sure you're not the family who finds out about these numbers 10 years too late. I'll see you in the next one.